Welcome. This is Tommy Ruke bringing you part 3 of work comp consideration. If during the program you have any questions, please type them in the chat window. And if time allows, we will answer them during the presentation. If we run out of time, we will email you the answer and also share it with the other participants if it's relevant to the subject matter and relevant to all. If you have any problems with the audio or other parts of this presentation during the time, you may type also in the chat window if you still have the program, or call our office at 800-741-4084. We'll attempt to correct the problems as soon as possible. Let's look at what we've talked about in the first 2 hours. Providing work comp coverage for interstate motor carriers. The problem is interstate operates and works in more than one state. A trucker who crosses state lines now subjects their operation to work comp jurisdiction beyond the state that they're based in, into the states that they have workers in. So providing work comp coverage is complicated because of this multi-state exposure. The key part of this that we all must remember is that each state has its own work comp law. When workers are in a state, the state work comp law would address their injuries. Requirements to have work comp coverage is also placed within the state. When we talk about it being mandatory, we're saying the state makes you have work comp, or they will put the insured out of business, and or they would fine them for not having work comp. There are, even when states are mandatory, there are numerical numbers where a worker does not have to have but so many employees before they are required to have work comp. You got to remember that in those numerical numbers, those workers are still employees, and even though the state in Florida does not, does not require you to have work comp until you have more than 4 employees, if one of those employees who works for your insurance and the comp is not in place, that worker could get hurt, and it could be the insured's fault they get hurt, and that worker sues. If that happens, there is no coverage in the auto liability and general liability in the policies because they're still employees. And since there's no work comp in place, there's no tort immunity. That's the danger of not having work comp coverage for everybody who works on behalf of your insurance. When a worker gets hurt, they will want to have their benefits paid. There are 4 basic types of benefit. The medical, everybody gets 100% of the medical. That is, in all state laws, medical is paid for 100% of the necessary treatment for a job-related injury. Indemnity pays for loss of wages. This is because the worker's ability to work has been impaired because of the job-related injury. And while they are off work, then they will get their pay. Typically, that pay starts either 3 days or 7 days after injury, depends on the state you're in. And then, if you're off for more than 2 weeks, if the worker's off for more than 2 weeks, they get those missed days back, either the 3 or the 7. The other place indemnity varies is the max. Most states have a max of $1,000. That max is 66 2/3 of the average weekly wage in the preceding 13 weeks, or some states have 91 days. It's kind of funny, but usually the last 3 months before the injury, they take whatever the worker made in those 3 months, and then they average it to how much they make per week, and then they get 66 2/3 of that amount. The 66 2/3 is supposed to mirror their take-home pay because there's no taxes taken out of it. And since there's a $1,000 maximum in most states, again, it varies, but I don't know of any state with more than $14,000 maximum, and I know any state will have a minimum more than a maximum more than $900. The worker today, who's a truck driver, doesn't make enough on an average weekly wage to max out. So basically the state indemnities based on states is not a concern other than the 3 days or 7 days where it starts. Their impairment is a concern. This is once I reach medical maximum improvement, then I'm not as whole, the worker is not as whole as they were before. So every state then allows an additional amount paid to them, either based on a percentage of their impairment as a function of their average working wage over a period of time, and or loss of body parts, eyes, hands, and those kind of things. And also death. Death is paid, but it's not life insurance. Death is paid to dependents. If your insurance workers have no dependents, then there is no death payment under work comp. For example, we had in a program that I had in Florida, an individual who was 23 years of age. They were killed when they fell out of a building. But they were living alone, they were not married, had no children, and his parents were not dependent on him, so therefore no death benefits was paid. But states do vary on death amounts. Florida's maxed out at $155,000. Other states can have death benefits far more than that, to the $300,000–400,000 level. So the states do vary. With those variants, you got to remember that each state then will decide if they can accept a claim or not, and that's called the extraterritorial provisions of the state law. The states will say that the individual can make a claim under the state they were hired in, the state they were employed in, the state they injured in, or the state they reside in. It's the workers' the choice, not the employer's choice. I was listening to a radio advertisement on Sirius Radio concerning Walmart hiring, and the lady on the radio says, we are going to have a recruiting hiring office in Tulsa, Oklahoma next Friday. If you are a truck driver, have a CDL, and want a new opportunity to work for Walmart and drive for Walmart, come to Tulsa, and we will review you and offer you a job. In all likelihood, some of those drivers that would be hired in Tulsa would be assigned to, say, a Dallas office, or an office in Arkansas, not necessarily Oklahoma. That driver also could live in Texas or Oklahoma, and therefore they would be that place of employment or place of residence. But as they drive through Kansas, they could get injured in Kansas. So this particular situation, the driver was hired in Oklahoma. The driver was employed at a terminal working out of Dallas. The driver was injured in Kansas and resided in Arkansas. That's the situation that the driver then would have the option of one of those 4 states to make the claim. So therefore, we have to set the policy up. As we talked about in the second hour, you need to list in 3A all the states that your insured has a place of employment, which a lot of times we forget is the residence of the driver. A truckload carrier driver takes their vehicles home, so therefore their residence is a place of employment. We want to list in 3C all other states that we might find the drivers in, except monopolistic states and states we list in 3A. You have to be an admitted insurance carrier to write coverage under 3A. In other words, to meet the requirements of the state law. And you must have, and sometimes you would have to write multi-policies as an agent or a provider to cover all the states that they might have a place of employment. You do not have to be an admitted insurance carrier to list it in 3C, because 3C allows the employer, your insured, the motor carrier, to pay the benefits and be reimbursed by the insurance company if the insurance company cannot make payments directly to the worker in that state. The reason they can't make payments directly to the workers in that state is because they're not an admitted insurance carrier in that state. So, but they still can meet the obligations of the insured for the payment of those workers. Because you have the multi-opportunities, you also have a concern about where premium is going to be allocated and in what state. The audit manual says that the premium will be allocated, or payroll will be allocated and premium developed based on the state where there is a terminal. Yet the definition of terminal under the audit manual is a location where the driver regularly goes to pick up loads and to unload. Truckload carriers don't have that exposure. They might have a payroll office. They might even have a yard with a garage in it, but their drivers are typically pick up loads at other locations and unload at the customer's locations, not at the terminal. You could base the premium on miles. Therefore, the IFTA reports where the insured reports their miles on a quarterly basis for tax purposes could be the basis of premium, depending on the period of time that those individual drivers or those individual workers spend in other states. For example, and this is an example that is used often, if your insured is domiciled in Indiana, which has a relatively low rate and therefore, and in most cases, a low benefit, but they spend the majority of their time in Illinois, your insurance carrier or the insurance carrier probably would want Illinois premium for those drivers because those drivers could live in Illinois or work the majority of their time in Illinois, and they would want payment based on those miles or the percentage of miles they travel in Illinois, not Indiana. The last place that is allowed in the audit manual is the driver residence. And of course, we know what their residents are in our business because we look at their MVRs and obviously their place of residence or the state of residence or the state that they have issued their driver's license, their CDL would be considered the state of residence. So therefore, you want to clear this up front. You want to give the auditor as few opportunities as possible at audit time to move payroll around. You want an understanding as an insurance provider, as an insurance company, and on behalf of the insured to determine what payroll and how payroll is going to be allocated to which state. We'll talk more about that in hour 4 about some of those options. What we want to speak in this time is the employee question. The state work comp law will determine if the worker is an independent contractor or an employee. This is extremely important, and this is one of the major concerns in providing insurance to the interstate motor carrier beyond the multi-state exposure. And this has something to do also with the multi-state exposure also. You have to pay for the injuries to the worker, or where will the worker get paid for their injuries, and what options do the worker have. As an employer, as a business, you worry about that worker suing you, and if they do not have work comp, then there's no tort immunity extended to the user of that worker, so therefore the worker can sue under tort, under common law, and therefore collect more than the amount that work comp would pay, and or would have an exposure under auto liability or general liability. And you also want to make sure that the work comp carrier at audit time do not consider these non-employees to be employees, and therefore the pay or the remuneration or the amount paid to these independent contractors would be considered payroll exposure under the work comp policy. That's your concern. Payment for the worker being hurt, the ability to the worker to sue or not to sue your insured, the motor carrier, and thirdly, how is premium going to be allocated? We all know, and we discuss in all lines of insurance, that the for-hire interstate motor carrier will use owner-operators, which in the broader term is independent contractors. That's someone they hire to be a part of their business, to do functions for their business that are related to your insurance business as a motor carrier, but are not, quote, employees of the motor carrier. When we, as an insured, when an insured does use owner-operated contract, it complicates work comp coverage, as well as exposures under general liability and under auto liability. So, the injured worker gets hurt. They want to be paid for the loss of wages. They want to pay for the medical they incur, and they want to get paid for anything else they can find. Their family would want dollars because of their death. So even though they're independent contractors, we need to realize that this worker has a relationship with the motor carrier, the insureds. So therefore, if they get hurt while working for, while performing duties, while on the location, while doing something that benefits the motor carrier, our insured, they will seek payment for those injuries, and one of the places they attempt to seek payment or would attempt to seek payment is from the people who work them. This is human nature. I don't care what you put in the contracts, I don't care what you say in the contracts, at claim time, depending on the severity of injuries, these workers or anybody would seek payment for the benefits here, and if they do not have satisfactory recourse in other places, would look at everybody possible, which would include the motor carrier who would work in them. Realize that this is human nature and this will happen. So we can't say it won't, we can't ignore it, we have to think about how to handle it. So when seeking benefit, how to get paid and how much is paid is a consideration. What coverage will be paid depends on was the worker an employee or not, owner-operator, independent contractor or not. If employee and the worker has work comp cover and the employer has work comp coverage to cover the worker, the employee will tell a representative of their employee, I was hurt. This is all that has to be stated. I was injured while working, while driving, while on the premises. That's it, period. The worker has to establish nothing else other than it was a job-related injury and therefore they're due payment for their loss of wages and their medical. The working compensation carrier of the employer would then start the claim process and pay benefits due under the state law the claim was made in. We went to those options earlier, but let's see, we've established now the law they made. There is no need to prove why the injury happened, meaning what did the worker hurt themselves or the worker hurt by the negligence of the person they're working for, our motor carrier. That becomes immaterial here because of the no-fault provisions that are commonly understood as a part of work comp. All the employee has to do was establish that it was a job-related injury. That's the concept of no-fault. Supposedly the system is quick, it provides benefits immediately, and most of the states attempt to write work comp to keep the lawyers out of the system, so therefore the payments and the cost of the claim goes directly to the benefit of the injured worker. Again, they're an employee and the employer has work comp. The payment of the job-related injury was based on the state work comp compensation law that would be paid under medical 100%. However, as we talked about in the introduction, their wages would be capped. It would be capped whatever the state is. Again, typically that's somewhere between $900 a week and $1,200, $1,300 a week. So therefore it's somewhere around $50,000 to $55,000. That's all that they can collect, no matter how much they make. They also would have impairment. Again, this is capped. So much for an arm, so much for a leg, so much of a percentage of injuries and impairment. Strangely enough, most states use the Minnesota rating base based in the formula coming out of a formula that Minnesota uses in that area, but they would get extra amount above that. Typically it's a function of their average weekly wage, a function of their impairment rating, which would be figured both on per item and the full body impairment, and then would get a percentage of their wage for a period of time, weeks or typically 4 to 5 years of that. But that's all they get no matter what. The impairment, as we talked about in item in area 2, is once they get in full medical treatment, meaning there's no more medical treatment that can make them any better. That is MMI, maximum medical improvement. Then they're not as good as they used to be, or they were losing some body functions that they used to have prior to the injury. That's what that's designed to be compensated for. And then the death benefits, again, it's not only capped, it is only to dependent. It's not life insurance. So a worker who was an employee can seek no additional benefits. Again, this is the sole remedy. So there's no need to claim why they were hurt as long as it was job related, and the benefits are paid, but that's all they collect. They don't collect more than that. The employer, your insured motor carrier, does not have to worry about that worker claiming more than what the work comp benefits are. Again, that's the sole remedy. The cost to the employer is the premium. It's based on the remuneration to the employee. State rates, where there is exposure, rate is based on either lost cost plus the insurance company or a state a fixed rate for the state that's approved by the state. So in lost cost states, some carriers have different tiers, and carriers do not charge the same rate per classification as they do in the fixed state rates, where all the insureds insurers in that state charge the same rate for that classification. We'll talk about rates and modification of rates, particularly experience modification, in the fourth hour. And this is based on the worker's activities. So then the premium is the remuneration to the worker, and the cost is the employee would have to pay that premium, again based on the rates and based on the activities and based on what state they have employment in. So the cost to the employer, the rates based on the industry average for the state. The premium adjustment could be size discounts, could be dividend participating plan, or could be experience bonds. Again, we'll discuss experience bonds in the fourth hour of our presentation. So, workers employed, hired as an employee, pays employee, then there's no question. But if a question, workers working for insured, and they do so as an independent contractor. Independent contractor, the worker gets hurt while performing duties for the business. Would they still want someone to pay their medical? Absolutely. Because they don't have money out of their pockets, they're looking for somebody to take care of it. They're losing wages. Do they want somebody to pay for those lost wages? Absolutely. They can't work. Their truck's parked. They're going to lose their truck. They might lose their house because they cannot work anymore because they got injured while driving that truck or working as a mechanic or working in the yard of your insurance. Would they want other? We hear the lawyers all the time. In fact, going through Orlando, going to the airport, there's lawyers who have signed, we got this individual $248,000. Thank you, lawyer. This happens all the time. How do they get those dollars? Again, the lawyers seek those and try to get benefits to as much as possible payment to these injured workers. And there could be other things that they might claim and other people who might claim. So independent contractor, again, depending on how they get hurt, they will be paid and by what policy. They would make a claim under tort. Tort is a wrong. So what we talk about claiming tort here is they would sue for their bodily injury because they were working on behalf of your insured, but they must prove that the employer, the user of that worker, the motor carrier, did something wrong, and that wrong contributed or caused that accident. So they must prove the injury was caused by a wrongful act of the business they are working for, and that wrongful act is the proximate cause of that injury. Very different than work comp. Work comp, none of this has to be proved. All they have to say is, I was hurt while working, and it was a job-related injury. Here, they have to be hurt while they were working, but they have to be hurt by a negligent act, by a wrongful act, by something that the person they're working for did. So the injured worker must establish the business was at fault. There could be a degree of fault consideration, contributory or contributory or comparative, meaning that the worker was partly negligent, the user of the worker was partly negligent. For example, that the worker got hurt because of fumes, that however, the employer provided the respirators that they would be using, even though the reason the fumes escaped for the negligent was caused by the negligence of the person they're working for, that allowed them to have the fumes and hurt their lungs or give them a rash or something like that. Yet, because they did not use the respirator, they are also partly responsible for this, so there'd be some splitting of that. But basically, the business was at fault. Therefore, the business could be sued. The claim then would be addressed by the business liability policy, either auto liability or general liability. Since they're not a worker, the worker exclusion does not apply. However, and here's what the damages they can claim: medical, all the medical, but not typically discounted. The advantage in work comp is that they have a discount procedure in most states, and most states allow to be discounted. A lot of them use the Medicare discount schedule. That's all work comp has to pay, or in some states there's a preferred provider mechanism, and so they pay they could have their own medical paid. Later we'll talk about OC Act, yet they could still seek more than that, those medicals, for the damage done by suing the person who they were working for if that entity was negligent, and even there were OC Act carrier would seek reimbursement. They could sue loss of wages. It's not capped. It would include not only what was established the last 13 weeks, but projected income in the future that they cannot make because they were injured. They would also seek impairment. Again, their future ability not to be able to work the same they did before, and how much income they will lose. How much that will be dependent of a judge or dependent on a jury, not a set fee as you would in work comp. Death, you would have death benefits beyond dependents. Whatever their estate would be a part of the death benefits that could be claimed. Others, pain and suffering, we all hear that. Spouses, loss of services, loss of, so in the cases you would not only have the employer and their estate to be sued and for their injuries or their estate for their death, but their spouses would also sue because of not being in the same companionship as they did prior to the injury. The point here is you have to prove the business was at fault, but the claim would be addressed under auto liability and general liability, and the claim would not be capped. It would be whatever can be established as damages, and that could be a function of how good the lawyer is, how sympathetic the jury would be or the judge would be, and other things in those places. But the point here, it's not capped. So a claim is not limited, whatever the attorney can prove. If there's enough limits in liability policy, the insurance carrier will defend and pay. This is why they buy auto liability and general liability. But if damages are beyond the limits in the policy, meaning it's catastrophic, and we have seen some work comp in the $4 or $5 million range. We had a worker that was run over by an item in the field. That person in the field got their stomachs cut open because the trailer that they fell under had no wheels, no tire on it, and so the wheels cut them. If that was an independent contractor, you could argue that the employer, the farmer, the user of that worker was negligent because they didn't have a wheel there, and they would make a claim for the things we talked about here. In that situation, that claim ended up costing $2.5 to $3 million before it all got settled because of infections and other things involved. If the insured only had $1 million policy, and were a substantial insured, meaning there was assets there that the lawyer for the injured worker would attempt to explore, they would then have the policy coverage for the $1 million, but they would still have to then defend themselves from excess and could end up losing their business. So again, depending on the catastrophic claims. The problem that we have in trucking in this area is that the auto accidents typically are catastrophic. Therefore, the injury would be greater than you would have in most places because of the danger of the impact and things like that. So the point here is that if the worker is independent, yes, auto liability and general liability would address their suits against the user of that worker, and their general liability, auto liability would provide defense and pay up to the policy limits. But the insured, the motor carrier, the user of that worker would be still exposed in catastrophic claims, yet not many, but catastrophic claims for those injuries. And if there's not enough limits in the auto liability and general liability policies to address these injuries, then they have their access of the business exposed. So that's the big difference. If their employee work comp pays and that worker cannot sue for more than the benefits provided under the work comp law, and the cost to the employer, to the user of that worker, would be whatever premium they have to pay. If they're a non-employee, independent contractor, owner-operator, they sue under tort. And in those cases, the auto liability and general liability would address that claim. And the worker can sue for anything they can establish as damages, again, as depending on the quality of the lawyer and what the lawyer has to do and the severity to prove the case and the severity of the injuries. And if there is limits within the policy to cover all that, then the employee or the user of that worker who's not the employer, the user of that worker who's not the employer, but the worker was working on their behalf, would have coverage in their policies. It would affect their loss ratios later, and their auto liability and general liability premium could go up as an adjustment later. So they would have not only the cost of the defending it, but if they have any deductibles concern in their policy, they would also have a rate increase later. That would be a function of what the insurance carriers who write their insurance feel the exposure is for auto liability and general liability. If there's not enough limits in the policy, then the assets of the user of that worker, your motor carrier, is exposed. When I first started talking CIC many years ago, the very first program we did was in Chicago in 1983, and Jerry Milton and I were two of the four speakers. And he made a comment that during that presentation, saying that when you engage for the work, when you set it up, everybody wants to be independent. The user of the person wants to be independent because of taxes and work comp and those costs. The worker who's performing the work wants to be independent because he wants to put more money in his pocket and not have those things deducted. But at the time of injuries, they want to be an employee because they get the benefits quickly. The worker hurts themselves, causing an auto accident, they want to be an employee and collect work comp. Worker gets hurt because of the fault of the business they're working for or they're leased to. They could fall off a dock because of failed guardrail. Then they don't want to be an employee. They want to sue under tort just like the public would to get more than the benefits of work comp. And if this is not cleared up, that's the option that the worker has to try to claim to be an employee if they hurt themselves, or try to say I'm not an employee and sue under tort to get more than the work comp benefits. In the case here where the option there, the work comp carrier would not want the worker to be an employee at injury. So they would fight the claim that they're not an employee. But that doesn't mean that at audit time they won't consider them an employee and get premium just in case. This is typically what happens in work comp. The work comp carrier would fight it that they're independent, yet at audit time the work comp carrier will attempt to collect premium for those workers. Again, you need to straighten that out up front, but those are the options that the work comp carrier would have in this case. If you have the claim and they're suing under tort, the general liability auto carrier would want the worker to be an employee. So therefore they try to establish that they're an employee. And so therefore the employee exclusion on auto and general liability would prevail and they would not have to pay. And in this case, again, you would have two of your carriers, your work comp carrier and your general liability or liability carrier fighting each other, so they would not have to pay anything. And that's, again, because there is a question in trucking concerning, are these independent contractors employees or not? Are these owner-operators employees or not? Plus the option of those workers to claim under work comp if they are injured themselves driving the truck, or claim under tort if they're sitting in the passenger seat and did not injure themselves, did not cause the crash. This is the options that the employer has, the employee has, not the user, and how their insurance companies would react. Why would the insured who's an interstate motor carrier want the worker to be a non-employee? Simply to save money. We always understand that. Taxes, SUTA, work comp, payroll taxes, and work comp premium. The real reason should be they're performing duties for the business that cannot be done by normal employees. And in the case of trucking, it would be because of the worker bringing their own truck. That's the definition of owner-operator to the workplace. The insurer does not have enough trucks. The motor carrier does not have enough trucks, so they hire the worker, and he brings or she brings the trucks with them to the workplace to accomplish these kind of things. Wow. So who determines if the worker is an independent contractor? The motor carrier? With no disrespect to most motor carriers you have, that's not the right place to do it. Their concept in a lot of cases, well, I 1099 them, thinking that's all it takes to be an independent contractor. That's absolutely wrong. There's no such thing, in my opinion, as a contract driver. Typically, a contract driver is someone the insured hires to drive the insured's own trucks. They 1099 them, and they say, well, they're independent because we don't tell them where to go. There's not a forced load board and things like that. They're going to probably be an employee under every circumstances that I'm aware of. So you need to make sure that the insured, the motor carrier, understand just because you 1099 that individual worker that they are not necessarily an independent contractor. State and federal government will step up. Why? They want their taxes. And if state and federal government comes in and audits your insured and challenges for misclassification, your insured could be liable up to 41.5% in taxes, interest, and principal for the past payment for misclassification. If it's set up, they could even be personally liable if the workers are misclassified, meaning they can't appeal and say, I don't, the business owes it, I don't personally. It could pierce the corporate veil. And the independent contractor would keep everything that they have been paid, nothing out of their pocket. So if the government challenges this, this would be a concern. There's cases that we hear, a lot of them unfortunately out of California, where the Department of Labor in California said that the motor carrier misclassified them, so therefore the millions of dollars that are owed to these quote independent contractors because they really weren't independent, they were employees. So the tax and the state government, the federal government for tax purposes are coming in and trying to collect premium or trying to collect taxes for these misclassifications because of their lack of it, or because of the need for the taxes to pay for the other people who deserve it, mainly not only income tax but unemployment tax, and they're very aggressive in that way. The work comp carrier will want premium for these potential exposure. This could be dependent on the state they operate in and how the state law defines employees. I'm in a situation now with a case in Orlando. It was written through assigned risk. This insured is domiciled in Florida. Their terminals in Florida. They have employees in Florida, but they also have 4 other locations that could be considered places of employment, either because they have terminals there where they load and unload, or the drivers live there. Those other 4 cases were North Carolina, Virginia, and Tennessee. And in this case, the auditor came in and said that these workers were employees, and therefore they owe money as employees. They were paid as employees, so therefore they deserve the payment that they made to them would be considered payroll in those states. Well, the auditor did make comments that the insurance carrier needs to look at each state law to determine if exactly these workers were employees or not, and they made a notation on that, but the assigned risk work comp carrier did not follow that notation and sent a bill to the motor carrier for additional premium in almost $1 million. As we investigated this, we found that in Florida, they're not an employee. So the payroll that was allocated to the Florida independent contractors would not be a part of the premium developed for the Florida exposure. But in North Carolina, they are. Under North Carolina law, an independent contractor, at least a motor carrier, is an employee. So in North Carolina, the payroll allocated to North Carolina would be legitimate payroll under that audit situation. And that's what we're talking about here. With a multi-state exposure, the work comp carrier could, at audit time, allocate payroll between these various states that we talk about here, and that would be the premium that would come back. Again, I'm going to suggest in the next session, the final 4 hours, that you do not leave this open. You get clarification up front, so your insureds, so you as an insurance provider, so the motor carrier and the auditor and the underwriter and everybody understands where and how payroll is going to be allocated and what is or is not an employee for audit purposes. This case, that was not done, so now we're having to fight that classification or misclassification. And as we're finding it, there's this $1 million potential bill that's sitting out there that the motor carrier has to reflect on their financial statement, and that's shown against them. It's not an easy situation, but this is what happens when you have an interstate trucker who have workers and place of employment and residence in multi-states. Each state law could be different to determine if they're an employee or not. But what carrier require independent contractors to have their own coverage? OCAC policy. This is very typical. Some even have arrangements where they have an ability to have a preferred program, and they do a settlement deductible for these work comp. So if they have an OCAC policy, why should the motor carrier worry about the worker suing them under tort, or even under the work comp premium, because they're covering themselves? Actually, the case I gave you in the earlier one, where we had almost $1 million additional premium in the various states, is because the insurance agent did not discuss with the insurance provider up front, would the insurance provider accept OCAC, E1 contingency comp, both of which we'll talk about later, to not charge premium. But what is OCAC? First off, it is not work comp. I was in a landmark case with a trucking company out of Western Pennsylvania, where the employee of the trucking company had the responsibility to, quote, enroll these workers, and they made the comment that OCAC is just like work comp. This worker had a catastrophic injury where the work comp of the OCAC policy did not address all of their injuries, and therefore they attempted to sue under comp, and those fatal words, OCAC is just like comp, caused the motor carrier to be liable for a lot of damages. Why isn't OCAC work comp? First, it does not extend toward immunity. What we're saying here is that that worker, if the injury is caused by the negligence of the user of that worker, your motor carrier, could collect OCAC and still sue the motor carrier. In fact, if their injuries are caused by the motor carrier, the OCAC company could even seek contribution or reimbursement from the at-fault user of that worker to pay back whatever they paid to that worker. The OCAC policy also has defined benefits. Amount totally paid. Typically, you would have a limit of $500,000 or $1 million. How often it's paid? Typically, indemnity would be limited to 2 years. Medical would be limited to 2 or 5 years. And then what is coverage provided? It's only to the worker who purchased it, to no other worker who might work for the purposes. It is an individual, personal life and health product purchased by an individual who paid them for their own injuries, meaning injuries incurred while working. It pays for both medical and loss of wages caused by these occupational injuries. OCAC versus work comp. Again, OCAC is an individual life and health policy providing benefits to the owner of the policy, no others. Work comp provides coverage to all employees of the insured, period. OC Act typically has two limits: amount, policy limits, and time, medical and indemnity. Work comp has no limit. It's unlimited, both in time and dollars, whatever the cost of the job-related injuries to the worker would incur. High medical bills, long-term disability, there could be some offset with Social Security or Medicare and Medicare and those things as they get older, but they are unlimited. OC Act does not provide tort immunity to the user of the worker, meaning that if the user of the worker is the cause of the injury, the worker can collect the OC Act and still sue under tort. And the user of the worker's auto liability, general liability, or out of their own pocket, depending on what coverages they had, would still have to pay in additional to the OC Act. The cost, and here's the problem. OC Act, depending on the benefits and limit, but for a typical $1 million coverage in most states is somewhere around $1,800 to $2,000 a year. Where work comp, again, depending on the rate and wages, would be typically $5,000 a year per employee. So the reason that a lot of your insurers are using is to save the cost of work comp and thinking that OC Act would protect them in these situations. And my only suggestion here is to be real careful. Those savings might not be a long-term savings. Even if OC Act does not allow them to sue under comp, you now have the injuries to be addressed under auto liability and general liability, and in those cases, how much additional premium will the auto liability or the general liability carriers seek for the payments to these owner-operators or to these independent contractors, and with that auto liability or general liability premium increase more than what the work comp premium would have been if they had work comp and had tort immunity. So you have the increased premium even if it's covered. If it's not covered, the insurer could have a real problem there because there's not enough limits and they could lose their company. That's what you have to weigh. Is the protection for tort immunity worth the difference in cost? That's not our decision, meaning the insurance provider decision. It's each individual motor carrier's decision, but I feel that we as the insurance provider need to explain to the motor carrier what these exposures are. So independent contractor collects under OC Act. Injury caused by the motor carrier the worker was working for. They collect OC Act, but would they want more? Yes, absolutely. Do they see all the lawyers advertising? Absolutely. Could they sue under tort? Yes. And still collect OC Act? Yes. The exposure is GL and auto. Remember, there is no tort immunity. But OC Act has contingency work comp. How does that work? If the worker attempts to make work comp claim, the OC Act will address the claim under work comp, not OC Act. Who benefits of this? The only person who benefits this is the work comp carrier of the motor carrier the owner-operator is leased to, when the owner-operator attempts to claim as an employee of the motor carrier. It's the injured worker who chooses the remedies, either comp or tort. So again, we go back to the scenario that we had before, where if the injury's bad, real bad, and the OC Act policy limits are exhausted, they will now want to be covered or get more dollars than that. And does the owner-operator have the option? Yes. If they're injured by the negligence of the motor carrier, they could claim under tort again and collect their OC Act. If the owner injures themselves and not limits in the OC Act to pay the injuries, they could attempt to collect as an employee under the motor carrier's work comp policy. And it could be either, it would be because of the owner-operator working for the motor carrier there, would be why they would do that. Even with OC Act and contingency work comp, can the worker still sue under tort? Answer, yes. It does not extend tort immunity if the worker wants to sue under tort. They can collect OC Act benefits they pay for on their own individual policy. If the injury was caused by the fault of the motor carrier, can still sue under tort. If the injury was caused by the worker, him or herself, they might want to attempt to collect under work comp. Why? Again, because they want dollars, and it's up to the individual injured to decide that, meaning that if the worker sues the motor carrier, even though OCAC, even contingency comp, you cannot make that suit go away by saying we have contingency comp. The suit would still go forward. It would only be when the worker attempts to sue as an employee, or not sue, but collect as an employee, that the contingency comp would step in. How about requiring the owner-operator independent contractor to obtain work comp coverage themselves, meaning they have work comp. We have that definition that we've had, the dead man policy, which would cover them. This would be something that would need to be done if the owner-operator independent contractor has other employees. Then the owner-operator independent contractor would have to have work comp, again, depending on the state numerical numbers that would be mandated to have it. But now in the marketplace, as most of us know, we have a lot of independent contractors, a lot of people with 8, 9, 10 trucks who no longer can function on their own, and now they're associating with a motor carrier for loads, advances, for help them with their maintenance and help with their safety records. And now they're bringing all those 7 or 8 trucks with those drivers to this new motor carrier, and therefore they have employees, even though they're still, quote, independent contractors. The injury is still caused by the fault of the motor carrier the owner-operator is leased to. Can they still claim under tort? Yes. The work comp coverage purchased by the owner-operator only extends tort immunity to the employer, which is the owner-operator, not your motor carrier. Your motor carrier would not be the employer unless the injured worker attempts to sue the motor carrier as the employer. But if they're working for the owner-operator, they would be the employee of the owner-operator. Tort immunity would be extended to the owner-operator, not to the person who they were working for. So who benefits work comp? Again, it protects the motor carrier's work comp carrier. It could say premium for the motor carrier, but it does not extend tort immunity. This is why we need to be very careful setting these things out to understand that neither OCAC or work comp extends tort immunity to your insureds, the motor carrier. Here's some consideration. OCAC, individual policies. So if you have other workers, OCAC will not protect the independent contractor from obligation under state work comp law or under tort, even with contingency comp. No protection from tort with OCAC, even with contingency comp, or even if standard work comp for motor carriers, independent contractors, at least 2 are working for. Motor carrier and work comp, if they use owner-operators and the contractor, will their work comp carrier still consider the owner-operator independent contractor employee for premium purposes? If so, then they would invoke a third rule would apply, which says a third of what is paid to the owner-operator independent contractor will be considered pay to the owner of the vehicle, and would be considered remuneration to the owner of that vehicle, and consider that as premium. Maybe not if contingency comp is statutory, no limits. Here's the big problem. And when you look at contingency comp, again, OCAC policies are not uniform. Contingency comp are not uniform. So contingency comp, if it's subject to the limits in the policy, most work comp carriers will not accept OCAC with contingency comp as subject as not developing premium for the owner-operator. It's only when the contingency comp is unlimited, meaning statutory. It pays whatever comp would have paid. So you need to watch that too. You want to clear this up front with the work comp carrier when you set this up. You don't want any audits at surprise time. Who is driving the truck on behalf of the motor carrier? They are not employees. However, owner-operators, independent contractor, employees. The key consideration is for tax and work comp, tax purpose and work comp. Misclassification. Who controls the activities of the worker? This is the primary consideration to establish independent contractor. Owner-operator agrees to transport property and does not receive specific instructions from the insured on routes or time frames, just where to pick up and unload. Owner-operator has the ability to accept or reject hauling assignments without penalty. Owner-operator hauls strictly for a fee, with no deductions made by the motor carrier. Owner-operator has freedom of movement. Those are some of the considerations for independent contractors. If you're an employee, drivers are required to report, call into the motor carrier. Motor carrier requires routes to be used by the driver. Motor carrier's name on the driver vehicle. Motor carrier has control over who its driver will be. If slightly down, driver will be employee for claims and audit purposes. There's different rules that also address owner-operator and laws in the work comp law as well as IRS law. When you think about that, this is why it's so difficult, because as we all know, the motor carrier has to have some control over the operation of the vehicle no matter who drives it. And so having these lines, they get blurred in the use of owner-operators. So you look at the lease wording and the statutes. That makes no difference here. The motor carrier written lease required to be signed before the independent contractor is allowed to work, not necessarily agreed upon by the worker, the government, or the work comp carrier. So the lease itself needs to be right, but that's not going to totally establish this relationship. There's no such thing, as I said earlier, for contract drivers. In today's world, the problem typically means when you use the term contract driver, the driver drove a unit owned by the motor carrier but had a contract that says they are not employees and then would be paid on 1099, and they could work at their option. If your insurer says that they have contract drivers, help to understand the problem. If they do not understand, then my suggestion is run from that exposure. For the owner-operator independent contractors operating on behalf of the motor carrier, they will be a lease. The requirements of the lease are in the 49 CFR 376.12. This addresses what must be contained to have a valid lease to allow the owner-operator to work on behalf of your motor carrier and under the motor carrier's regulatory registration and authority. Short leases don't work. I've seen them 1-2 pages long. The lawyers that we're dealing with saying to meet all the requirements of the under the Federal Act to be leased, the lease must be 7 or 8 pages long. So therefore, they need to go to the lawyers who specialize in this. The problem we have also under the Federal Act for employee. Employee means, this is a definition of the Federal Act, any operator of commercial motor vehicle, including full-time, regular employment drivers, casual, intermediate, or occasional drivers, lease drivers, and independent owner-operator contract while in the course of operating a commercial motor vehicle. So while your driver, no matter who they are, for your motor carrier is driving your motor carrier's vehicle with the motor carrier's name on the side, under Federal Act, they're considered an employee. This is because they have to control them. They have to hire them using the standards of hiring if they have a CDL, just like they're an employee. The employer means any person, including the U.S. government, who owns or leases a commercial motor vehicle or assigns employees to operate such a vehicle, employee under the definition above. So the federal definition of employee includes anyone who's operating a commercial motor vehicle. The motor carrier must be careful and make sure that their classification that their independent contractor hold up and have to overcome both the control factor and the definition of the federal level for operating the commercial motor vehicle. And the contractor, and here's the key, the test, must own the vehicle or have a legitimate lease. Lease purchase or installment purchase. It cannot be leased from the motor carrier based on the lawyers that we talk about. It can be an affiliated leasing company that's owned by the motor carrier, but it has to be a separate legal entity. So the insured or the owner-operator can lease the vehicle from this leasing company and then lease that leased vehicle to the motor carrier to operate. That would be established. However, the terms of the lease must be a customary, available, and retail transaction. The problem is there's typically no similar transaction because of the credit rating and the down payments issue. And so there's no similar lessors available. The motor carrier must form separate legal entities and plan carefully for tax consequences as they move these vehicles to these other legal entities. With that, even in the separate legal entity, the motor carrier must be able to take the truck to another motor carrier, still leased to the vehicle leased to the leasing company that's owned by the motor carrier. If they don't have that portability, they can't take it. Again, they would be considered, in most cases, an employee. So truck must be leased to the motor carrier with the FMCSA valid lease agreement. And then we talked about it's lease of the power unit, not driver. Detailed performance. Where does your insured come from? Where does the insurance contract come from? Who wrote it, and when was it written? Those are concerns here. It must be legitimate. A lot of them are copying somebody else's, and that's a real problem. They affect motor carriers, the misclassification, their insurance providers, as well as the insurance producers. So when providing work comp coverage to a motor carrier, everyone needs to view the classification of the workers the same and agree on the classification. If not, there are problems. And even if they agree, there could still be concerns.